Shopping for financing to purchase a new home is not exactly the same as shopping for new appliances, but there are some similarities. I'd like to introduce Jane McNamara, the President and CEO of GreenPath Debt Solutions, a not-for-profit organization that helps people enjoy a better quality of life through financial counseling, education, and also by offering solutions to help individuals and families plan for their future. Jane will talk with you about getting the right loan when buying a new home.
Like shopping for any major item, you'll find there are a number of options when you look to finance your purchase. You have to decide which one fits your individual needs. It is very important that you investigate all your options and understand the benefits and limitations of each one. To understand these products, it's best to divide them into two broad categories: conventional loans and government guaranteed or insured programs. Here are some expert insights into some important differences.
Okay, now there's a difference between a conventional loan and a non-conventional loan. A conventional loan is a loan that's made by a private sector mortgage company. And the thing is, with private sector mortgages like conventional loans, there are two categories of those as well. You have the non-conforming loans and the conforming loans. You're typically going to get a better deal if your loan is considered to be a conforming loan because it conforms to the standards of Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac purchase about half of all the mortgages in the United States. And if your loan conforms to their standards, your interest rate's typically going to be a better interest rate than a loan that does not conform to their standards. So if the conventional loan is not guaranteed or insured by the federal government, it's held by a private mortgage company, so you're negotiating basically with the private mortgage lender.
The other common choice a home buyer has is an FHA loan.
Now, an FHA loan is different than a conventional loan. An FHA loan is insured by the federal government. So the government is guaranteeing that if you default on the loan, they're going to cover that for the mortgage company. Now, in exchange for the insurance, you're going to pay what's called an upfront mortgage insurance premium, and you're also going to pay insurance on an ongoing basis that you include with your monthly payment. Now, the thing about that, and all the other closing costs that go with an FHA loan, is that you can ask the seller to pay the closing costs for you. Now, even if the seller pays your closing costs, like your title insurance, and some of these other costs, you might still be able to, come to the closing with only about a 3.5% down payment, because that's typically what's required, at least traditionally, for FHA loans.
Here's more on that same subject.
Now, another form of a government loan, except this one is exclusively available for veterans, is what's called a VA loan. And this is where the Veterans Administration is guaranteeing the mortgage. And in exchange for that, you pay what's called a VA guarantee fee. And the VA guarantee fee is tax deductible in the year that you pay it.
A mortgage is a special type of installment loan that makes a house affordable by spreading monthly payments over a 15 to 30-year period. Before you apply for a mortgage, you need to understand the difference between the two principal types of interest rates.
There's a difference between a fixed mortgage and an adjustable rate mortgage. A fixed mortgage is where your interest rate and your monthly payments are fixed for the entire term of the mortgage. So if it's a 15-year loan or a 30-year loan, then your interest rate or payments cannot change for 15 or 30 years. Now, on the other hand, an adjustable rate mortgage is where your interest rate and your payments could change after that initial fixed period ends. So, for instance, there are 5-year adjustable rate loans or 7-year adjustable rate loans where the interest rate's fixed for maybe 5 or 7 years, after which point the interest rate and your monthly payments also would adjust and they would change.
So when you think about an interest rate, there's going to be many options that are out there. You would have the option potentially to do a fixed rate mortgage or to do a variable rate mortgage, like an ARM, the adjustable rate mortgage. For me, I would always consider what my time horizon is that I want to be in that house to start with. So for example, the fixed rate mortgages may be a little bit more costly with interest rate. However, it will last for 30 years typically, or 15 years, and you'll get a set rate that you can pay. If, however, you think that you're only going to be in the house for like 5 years or 7 years, you can go out and see if you could get an adjustable rate mortgage that will have probably a lower interest rate. So it'll save you the costs, but yet it will be okay because you're going to get out of the house in a shorter amount of time.
Here's more on that same subject.
Now, there's a difference between an amortized mortgage, which is traditional, more or less, and there's an interest-only mortgage. An amortized mortgage includes both principal and interest with your monthly payment. On the other hand, an interest-only mortgage gives you the ability to pay interest only, not including any principal, for the first 5, 7, or 10 years, typically, of that mortgage. And the reason that's beneficial in some cases is because, for instance, if your income fluctuates, if you're self-employed, maybe one month you can pay interest only, the next month you can include some principal. So it gives you a little bit more cash flow flexibility. The danger with that flexibility, of course, is that if you don't make any principal payments, your mortgage balance will not be reduced and it will stay the same for that period of time.
I want to add something to what you just saw. If you are considering an interest-only loan, be sure you understand and discuss the program benefits and risks with your home loan consultant. It's been my experience that first-time buyers, and even people buying their second or third home, often don't realize that there are a number of elements that need careful comparison shopping. They may not realize that in addition to the interest rate, the down payment, points, and term are all negotiable. Each have to be compared to what is being offered by a particular lender.
My advice to consumers is to spend as much time to learn about their options and what's available in the marketplace. This is probably the most important decision that they will make in their lifetime. A traditional down payment for a mortgage would be 20%. Today there are mortgage programs that have down payments as low as 3 to 5%, and in some cases even zero. What needs to be considered is that the lower the down payment, the more that you would have to borrow for that mortgage, so your payment would actually be higher in those cases.
Often when shopping for a loan, borrowers will hear the term points. It's important to understand that a point represents 1% of the loan amount. Borrowers need to understand when they're shopping for rates that lenders will quote interest rates with and without points. Generally, the more points that you pay, the lower your interest rate. So you have to take that into consideration as you compare one financial institution to the other. For qualified borrowers, the down payment is generally their choice. The size of the down payment they want to make can range from 0 to 20% or greater. For members with some challenged credit, they may be required to put more money down. The decision on what size of down payment to make is important. You don't want to exhaust all of your funds.
You have to have some cash set aside for reserve purposes. Don't use all your cash for strictly just a down payment.
The terms of the mortgage are another important consideration.
The mortgage is a legal and binding contract. You're signing a loan document for tens of thousands of dollars, sometimes hundreds of thousands of dollars. You need to understand all of the things that we've talked about in the past. The rate, whether it's fixed or variable, when your payments are due, whether they include taxes and insurance.
The borrower needs to understand the terms of the mortgage itself and even the accompanying documents. It's legally binding throughout the life of the mortgage, and so it's important that they understand all components of that. If they don't understand, don't sign it. Ask for professional advice or advice of trusted individuals that you know.
Good credit is one of the biggest assets you can have. You want to build it and you want to protect it. Your credit standing is a major factor in evaluating your application. Lending institutions generally use a number of factors to determine a borrower's qualification for a mortgage loan.
A credit report is what any lender would look at to give them a sense of your history of adhering to the terms of any loan that you've had in the past. It's a vital part of the decision-making process and something that you really need to keep in good stead.
Your credit score determines the interest rate that you pay or the price that you pay for that money that you're borrowing. Now, when you're looking at your credit score, you want to first make sure that you're making your payments on time, because payment history comprises about 35% of your credit score. And so if you're not making your payments on time, 35% of your score is affected by that. 30% of your score, on the other hand, is affected by your balance to limit ratio. So for instance, if you have $10,000 of credit available to you and you're maxed out at $10,000 that you owe on that credit limit, that's going to very negatively affect your credit rating.
It not only determines the rate that you're going to pay, but it also lets the lender know your ability to handle your debts. Are you able to service the debt that you have right now? Do you pay your creditors on time.
One of the key factors is the adequacy and the legitimacy of your down payment. They'll be looking at your bank statements for a couple of months to ensure that you've had it there for a period of time and that you didn't borrow it elsewhere.
Unfortunately, when you go into the housing market, you also have to be aware of what are termed predatory lending practices, loans provided by unscrupulous lenders. As a borrower, you should be as knowledgeable and as informed as possible. Above all, whenever you suspect that a loan might be too good to be true, it probably is.
One of the things that we caution anyone who is looking for a mortgage against is the fact that there are predatory lenders that enter the marketplace from time to time. These are rather unscrupulous individuals that might ask you to sign documents in blank. They might ask you to lie on a credit application, and you might see fees that are exorbitant. You might be told that you qualify for a high rate of interest when you actually qualify for a lower rate of interest. That is a primary reason why you need to be informed. You need to understand what's available in the marketplace, and you need to seek advice when there's something that you don't understand.
Additionally, a borrower is given a disclosure statement at the very beginning of their loan application process. Many times, by the time they get to the closing table and look at their closing documents, the fees are far different. They're being sold ancillary products that aren't required as a condition of the loan, and they're often told that those are requirements to qualify for the loan. These predatory lenders are putting money in their pocket at your expense.
So for instance, if you agreed in the beginning not to have a prepayment penalty on your loan, then at closing you should be aware that there should be no prepayment penalties. If you agreed to have a fixed interest rate in the beginning, then at closing you should make sure that it's a fixed interest rate, it's not variable.
It's important for you to do your comparison shopping. Go and visit several lenders to make sure that the numbers are the same from lender to lender. They shouldn't vary that differently.
Now just remember, when you sign those final mortgage documents, you're obligated legally to adhere to those terms. So, if you don't adhere to the terms, it affects your credit rating, it affects your ability to stay in that home on a long-term basis, and it's a legal document that you're signing.
You're going to be into this contract for a long time.
It's natural to be emotionally involved in buying a new home, but our perspective at GreenPath is that buying a house is a business decision. You need to approach it unemotionally so you can evaluate all your opportunities. Evaluate the risks and benefits, and then make the decision that is best for you and your family.
The lender's primary concern when considering you for a loan is that you'll be able to repay the loan. The way you've handled paying your debts in the past is usually the best indication of how you'll act in the future. Some important factors are known together as the 4 C's. First is capital. That's the amount of cash and other liquid assets that can be used for down payment and closing costs. Second is capacity. That includes your present income and financial obligations. This helps to determine if you can afford to make the payments. Third is credit. Your credit history, as it's reported from credit reporting agencies, shows your commitment towards paying your debts on time. Fourth is collateral. The property you are buying is the principal collateral for your loan. This is what the lender gets in case you default on the loan. You need to know where you stand on each of these factors when you start shopping for a mortgage loan. Thanks for tuning in. We'll see you next time.